Today we're diving into something that I think a lot of people get tripped up on. And that's these high-yield ETFs.
Yeah.
And this idea of erosion.
Right.
We all like those big juicy yields.
Right.
But then you hear these stories about your investment shrinking over time.
Yeah. It's funny how the term erosion gets used because it gets thrown around a lot.
Yeah.
But it's misused when talking about these ETFs.
Okay.
True erosion is like with leveraged or inverse products.
Yeah.
That means something's gone and it's not coming back.
Yeah. Yeah.
Like, you've lost it. That's not what's happening here.
So it's like more of an optical illusion than like an actual disappearing fact.
What we're really seeing is what's called NAV depletion. Yeah. And it's a temporary decrease in the ETF's net asset value. And it's because of the dividend payouts.
Right.
And here's the thing. All ETFs that pay dividends experience this to some degree.
Really?
It's not just a high-yield phenomenon.
So even the big, reliable ETFs that everyone loves, like...
Exactly. Think of it like this.
Yeah.
When an ETF pays out a dividend,
yeah,
it's like taking a slice out of the pie.
Okay.
The pie itself, which is the NAV, gets a bit smaller.
Right.
But the slice you get is real value that you're getting paid.
Yeah, yeah.
Take SPY, for instance, the SPDR S&P 500 ETF trust. It pays dividends.
Right.
Its NAV dips a bit each time.
Right.
But because it usually recovers pretty quickly, most investors don't even notice.
Right. So the question isn't if depletion happens, but how much and how quickly it recovers.
Exactly.
Okay. But then why is it so much more noticeable with these high-yield ETFs?
Well, it's a matter of scale.
Okay.
The higher the yield,
yeah,
the bigger that dividend slice is relative to the overall pie.
Right, right.
So it's like imagine getting a hefty allowance as a kid, but having to use most of it to cover expenses.
Oh, okay, okay. So I see. So it's like you're getting lured in by this big payout.
Yeah.
But you might be sacrificing potential growth
down
the road to get it.
You hit the nail on the head. It's a trade-off.
Okay.
And that's why we always emphasize looking at total return. That's dividends plus NAV appreciation.
Yeah.
Rather than just chasing those sky-high yields.
So even if an ETF boasts a seemingly stable NAV, it could just be an illusion.
Exactly.
Especially if we're in a strong market.
That's where recency bias comes into play. We get caught up in the recent performance and forget that what goes up can also come down.
Yeah.
Those drops can be a harsh reality check.
Right, yeah. It's a good reminder that past performance is no guarantee of future results. It makes me think about something you said earlier. You mentioned that high-yield ETFs often underperform compared to a simple buy-and-hold strategy in the long run. Why is that?
It comes down to what these ETFs are trying to do.
Okay.
They're designed to generate income, not necessarily maximize capital appreciation. Think of it like owning a rental property.
Right.
You're getting a steady stream of rental income, but the value of the property itself may not go through the roof like a high-growth tech stock.
Right. So you're trading some potential upside for that steady cash flow.
It's a great analogy.
Right.
And while that income can be super valuable, especially for people who need that reliable cash flow, it's important to understand that trade-off.
Yeah.
Imagine an ETF like, say, Round Hills XDT. It sells covered calls to generate that premium.
Right.
That's what gets paid out to you as dividends.
Gotcha. So they're using these option strategies to generate income.
Right.
And we benefit from that through the dividends.
Right.
But how does that impact the actual value of the ETF, the NAV?
Well, there are a few factors at play.
Okay.
First, as we talked about before, those dividend payouts, they cause that temporary dip in NAV.
Okay.
Second, the success of those covered call trades really matters. If the ETF consistently makes good trades, it can offset that depletion from the dividend payouts.
Okay.
And the NAV remains steady or even goes up.
But if those trades aren't doing so hot, the NAV takes a hit.
Right.
Even beyond the dividend depletion.
Right.
So it's this balancing act.
It is.
Between the dividend payout, the performance of the options trade, and even the underlying asset performance.
You got it.
Wow, okay.
It's multifaceted, and that's why it's so important to look under the hood, right? Don't just get seduced by a flashy yield.
Right, right.
And this brings us back to recency bias.
Right.
Just because an ETF seems to be holding its NAV steady during a bull market doesn't mean it's immune to the forces of depletion or broader market downturns.
Right. It's like those miracle ETFs that seem to defy gravity for a while.
Right.
Even ETFs that appear rock solid can experience big NAV drops when the market turns.
Absolutely.
Past performance is no crystal balls, right?
Exactly. And even with these income-focused ETFs,
Yeah.
there's still risk.
Right.
The biggest one, aside from general market risk, is that NAV depletion could outpace those dividend payouts.
Oh, so you could be getting those nice dividends, but the value of your investment is shrinking faster than the income you're receiving.
Yeah.
That's scary.
It is. That's why you got to do your homework.
Right.
Understand the ETF strategy, the quality of its assets, the historical performance of the options trades.
Okay.
Don't chase the highest yield blindly.
So it's not just about finding the sweet spot between yield and growth.
Yeah.
It's about understanding the mechanics,
managing
risk, and making sure your investments match your goals.
You got it. If you're mainly looking for income and you get the potential trade-offs, then high-yield ETFs can be really useful. But if you're more focused on long-term growth, other strategies might be better.
So it all comes back to knowing what you want and making informed choices.
Absolutely.
So for those of you thinking about diving into these high-yield ETFs, do your research. Think long-term. And remember, slow and steady often wins the race.
Absolutely. And if you're still unsure, talk to a financial advisor.
Great advice. So we spent some time today really unpacking these high-yield ETFs, separating, fact from fiction, and hopefully giving you the knowledge to make some good investment choices.
Absolutely. I think the biggest thing we've tried to illustrate is this whole idea of erosion being a misnomer when it comes to these ETFs, and understanding that dip in NAV, that depletion, is just a natural part of the process of paying those dividends. It's something that all dividend-paying ETFs experience.
Yeah, and we talked about the mechanics of it all, how those dividend payouts work, how the option strategies impact things, and how the underlying assets all factor into what that NAV looks like at the end of the day. But I think the biggest takeaway for me is to focus on that total return.
Absolutely.
Not just chase those yields.
Yeah, remember, you're giving up a little bit of that potential future growth for that steady income.
Both have their perks.
Yeah.
But it depends what you're going for.
Exactly. What are you prioritizing? And even if you do decide that high-yield ETFs fit with your goals, don't forget to diversify.
Oh, yeah. That's huge.
Spread the risk around.
Don't put all your eggs in one basket.
Invest in a bunch of different ETFs. Maybe ones with different strategies or different types of assets.
And I think another key point that we've touched on a couple of times is this power of reinvesting dividends.
That's right.
That can really help mitigate that depletion and set you up for success over the long term.
Think of it like planting a tree.
Okay.
You plant the seed now, and then it slowly grows over time and gives you shade and fruit.
Yeah. I think we should leave everyone with a question to think about.
Okay, I like it. What do you got?
So if high-yield ETFs are really this trade-off between growth and income, are there other strategies out there that might give us a little more balance?
Interesting.
Maybe strategies that give us both that steady income stream and that potential for some nice growth over time.
That's a fantastic question for listeners to explore.
It is. It's something I'm going to be looking into myself. And remember, there's no magic formula.
Nope. No one size fits all.
What works for you depends on you.
Right. Your circumstances, your risk tolerance, and what you want to achieve in the long run.
So keep learning. We'll see you next time.